More, what strategies are you trading in this market? This is the continued discussion I mentioned that Chuck had started from last week, and we had some other ideas that came through during the week. But last week's discussion was prompted by Chuck, who shared his thoughts and was curious of what is working for other power options users and YouTube followers in this market. I reviewed that I'm still doing married puts, some bearish forms of a standard collar position. Didn't work out that well this week moving up, but they're still all in the safe zone to get profit. Adjusting calendar puts and bear put debits. The out of the money strangles on SPY or QQQ, which reversed, but we're looking pretty good today. Earnings plays on the ETFs haven't really started that yet, although the banking ETF was looking interesting and some others were, but I haven't really started to get too much into those. I did buy another put on XRT the other day after the market had been up for 4 days. And shares of volatility ETFs, but I must admit, we'll take a look at this later, I did buy some calls this week on the VIX when I saw it drop below 24. So it hasn't been down to 23 and stayed below 23 for a while. But let's just move on to the recap from last week. Chuck said he was in 99% credit spreads, bull and bear, looking to make around 1% per day or 5% per week with around a delta of 0.10, 90% probability or higher. Had a discussion with Steve, who's starting to look for quick call and put buys, 1 to 3 day trades using candlesticks as his indicators. Don had discussed a couple weeks ago looking at 20% out of the money credit spreads on SPX, looking for a 1 to 1.5% return with an extremely high probability, 90, 94, 95% for 30 to 45 day trades, something to keep him comfortable that he didn't have to feel like he had to watch on a consistent basis. And we had the gentleman who was using the monthly naked puts and covered call picks of the day on power options, was doing 1% per month, but then that sort of turmoil in June sort of hurt most covered call trades and most naked put trades as well with the declines that we saw. And then Bob had brought a question of rolling diagonals against the leaps, his approach for what he's looking to do, the poor man's covered call approach. After last week's discussion, after the webinar ends, there's a survey that comes up when you can tell us your thoughts about the presentation or any questions that you have. And Troy added, I am trading several covered calls on UVXY, 3 to 5% out of the money for 2 weeks out. UVXY is the ProShares Ultra VIX short term. So it kind of reacts with the VIX, but it's a different sort of volatility ETF. You can buy shares of it, which you can't do with VIX because it's an index. Protection is a married put, a radioactive trade on SVXY, which is the inverse VIX short-term ETF. Following the rules in the blueprint, it means adjusting as you suggested. So he's doing a covered call on one volatility ETF that recently has been declining, but you see the moves over the last 3 months there on the left. While at the same time doing a married put on the inverse ETF, which right now is starting to move up. So he's got positive delta on the married put structure. But a week ago on July 15th, sorry about the $2 signs, UVXY was at 1244. We could have bought 100 shares. He's doing more than that at 1244. We could have sold to open the 2 week out calls that he mentioned. July 13th strike, that's 4.5% out of the money. He said 3 to 5%. So we're right in the wheelhouse there for 78 cents. Now the stock has pulled back about 34 cents. We took 78 cents of premium. And if UVXY starts to move up, meaning the market's coming down, so UVXY would push up and he gets assigned, it's a potential for an 11.5% return on this structure. Meanwhile, with SVXY, it's currently, well, it was, I'm sorry, on July 15th, 5061. Following a married put structure based on the guidelines in the blueprint, if I bought 100 shares at 5061, I would have bought the December 55 put about 170 days out in time at that point. I think it was 154 days, I'm sorry. And that was 725. So the maximum loss on that married put was 5.4%. So in one structure, if the market is falling, UVX is going to go up and SVXY is going to go down as an inverse. If the market's moving up, as we've been seeing, that's why SVXY has been increasing in price, the inverse volatility ETF. I know it's a little strange, sometimes a little confusing. Whereas UVXY has been declining as volatility has been declining from the market going up. But the call premium is acting as a hedge, and he's getting positive delta on the upside married put structure on SVXY. And right now, it's actually ironic. Both are still profitable based on the closing prices on July 15th. This is a look at the power options portfolios. You can see the SVXY married put position is a profit of $8. Now, this was about 3:15 this afternoon, I believe. I didn't check it again at close and grab a screenshot. But meanwhile, as we mentioned, the covered call position is down, but he's gained 40 cents on the premium. So he's still up $10 right now on that. Again, this doesn't look like a lot of return. And sometimes you expect to maybe see a wash. We had a couple discussions earlier on with a gentleman who asked, is it a good idea to do a covered call on a regular ETF and at the same time do a covered call on the inverse? And we talked about why that's not a good idea. But at the same time, is it a good idea to do a married put on an ETF and also do a married put on the other one? So if this really moves up, I can get maybe 5 to 10% profit on the married put on this side, but worst I could do is lose 4 or 5% on this side. You need a much larger move to see those numbers, and we weren't really seeing that. It ended up being a wash. The reason why Troy's approach is a little bit different is because he's using a covered call on one structure, which has a good potential upside positive return. But if this hits the max return, the absolute worst case scenario he could do on the married put, and that's all the way out to December, would be to lose 5.4%. So there's a potential with both of those directions. You could probably do it reverse too. I'd have to ask Troy about that if I did a married put on UVXY and did the covered call on SVXY, but I guess that depends on market conditions and how each is reacting to it. We can see how this might work over time. We're generating income even as UVXY is declining. So, I mean, here, if I bought back at the peak, we would have bought in at 17, and every 2 weeks got a cycle of maybe 70 or 75 cents or so. I mean, it's down about 5 points, but we would have cut into that. Meanwhile, we'd be profiting if we bought at the bottom down here on SVXY on the right from 46 to 51. We would have been making profit on the married put. And this doesn't include doing the income methods that are discussed in the blueprint against the married put, which Troy said he was doing as well. So that's kind of the approach. Now, this one's going to be a little bit of discussion. It's more words and everything than an actual example. But we're just going to walk through this. Jim A., regular power options customer, emailed in, and he said, based on the webinar, for trades, I've been doing mostly vertical spreads, bull put and bear calls, also some calendar spreads. He scans for stocks that are up 2 months in a row, and then look at each chart that passes the scan. If the stock is trending, the 20-day is still above the 50-day, he'll wait for a pullback to value and then a resumption of the trend. He goes on to say value, he means you can define it anyway, a pullback to a moving average and bounce, looking left for the most recent support on the chart and consolidating. A reversal bar such as a hammer, a failure test using Bollinger Bands or Keltner channels. I typically use the Bollinger Bands myself, but Keltner channels are also very useful. Jim says the key is to be consistent. If you define value as a pullback to a moving average, it is always a pullback to a moving average. The trade is not a moving average and a test of the lower Bollinger Band for the next trade. The other way he scans his look is 52-week highs for longs and 52-week lows for short positions, bear call credit spreads, maybe bull puts. And he goes through a lot of examples here. We're just going to look at a few, but he says, here's a sampling of some of the stocks and ETFs I've traded on this method. And I'm not going to go through the whole list here. As you're watching this video on the replay, you can write these down. But he said, I would suggest that now you have a good short candidate if a stock is trending higher and then breaks the trend. Oil stocks recently like OXY, CVX, and OXM starting in the second week of June. He says assets starting in January and April, and Costco in the third week of April as some examples. He does add a follow-up that was very similar to what Chuck mentioned last week about taking profits on the spreads early. And I think there was another gentleman who said that as well. As you know, not every trade is a winner. Follow the advice of Linda Bradford Rashke and do not get greedy. Take profits at the previous pivot high or when a 20 to 25% gain based on the cost of the trade. So he'll take profits at 200 to 250, 20 to 25% if you had a debit of $1,000, for example. And the cost of my trade and my risk on the trade is not the same. However, the risk of the trade is always less than my cost. And it's typically going to close below the most recent consolidation levels and the pivots as well. Now, let's just jump into it. Here's what he was talking about. The second week of June for OXY, what were we doing? I usually have the Bollinger Bands in here, and this was riding the upper Bollinger Bands for a while. And then it sort of broke down. I think it was about here. And then just started to go. So I think what he was talking about here is here's a stock that was above the 20-day moving average, and the 20-day, excuse me, is also above the 50. It was riding the upper Bollinger Band, and then the trend changed and then snapped. So this is what maybe the pattern he was looking for starting in the second week of June for a good short opportunity. And then when things changed, he might have reversed his idea at that point. Still would have been a good reasonable short even into here. If we shorted up here, did a bear call credit spread, bear put debit spread, a calendar put spread, something along those lines. So that's sort of what he was referring to on the charts that he referenced. And going back further, here's the Costco position back in April, that third week of April, where what are we doing? We're riding that upper Bollinger Band, as he mentioned, and then the trend suddenly breaks. At this point, the stock's below the 20-day moving average, but at the same time, the 20-day probably dropped below the 50-day, and he's saying this might have been a target point he would look for that kind of short bearish position, which would have worked out extremely well. But then the trend here reverses again, gives a little fake out, but now it's doing this. So at this point, we definitely would have been out of the short sometime probably in here, as he mentions, as you see the trend reverse, and might have switched to a bullish pattern in that case. Not sure exactly, but that's sort of what he was pointing to with his discussion of what he was doing. So similar to Chuck's discussion, doing mostly bear calls and bull puts, following certain trends. Jim A is doing very similar. He gave us some more insight with that case. Jim says that is right on the trades, Mike. Yeah. Okay, excellent, Jim. Jim's final comments, and I'm sure it's what many of you are thinking too. This year's market is one of the most frustrating I've seen in my several decades of trading. Trends have been short and erratic, but every market provides an opportunity to make money. If you're organized, disciplined, follow the market and what is in favor. Yes, the market's falling, but energy commodities are rallying. We saw that the consolidation, right? Tech stocks were the biggest hit end of December, beginning of January. People were leaving the pandemic darlings and the tech stocks, and where were they going? They were going into banks and they were going into oil, going into different types of things. Some people went into gold, but the gold didn't work as a good hedge because the dollar started to get stronger, and that countered gold as the typical hedge you might use on the portfolio. Okay, but the market's going sideways, but biotech is rallying. These are all things to see. What is rallying and in favor today, not last month or last week? You can go long, what is in favor, and go short stocks that are trending lower. And of course, I'm going to throw this in there. Jim did mention I'd also like to take this opportunity to tell you what a great job Power Options and the RPM teams are doing. Mere radioactive trading techniques. You provide tools, trading, and material that are head and shoulders above most groups providing information on options. Great job, and please keep it up. Thank you, Jim. You know that I will always try to do my best. So those are just some other ideas there from Jim and from Troy on what they're trading in this market. And of course, I always want to put up this disclaimer. I have not verified the returns or done historical tests with direct examples from what these suggestions are and the approaches. Options trading involves risk and may not be suitable for all investors. Always practice proper position sizing, as Jim mentioned. Never risk more than you can afford. And have an exit strategy for any investment strategy. Fully research all aspects of a strategy, the rights and obligations of what you're selling and what you're buying before you put on any type of position.